Welcome, friends. In this series of debt funds, we have dwelled upon so many funds so far, like liquid funds, overnight fund, ultra short fund, low duration fund, short term fund, medium term fund. So we have seen different risk associated risk with these funds, where we have seen mainly three types of fund, these three types of risk associated with all these types of funds. First is default risk. Second is credit risk. Third is interest rate risk. Apart from these three, after this unraveling of Franklin Templeton saga, people come to know about this liquidity risk also. And from there onwards, people care for liquidity also. There are two types of liquidity associated with any fund. First is lack of liquidity in underlying debt funds or debt bonds in which the mutual fund have invested. If there is liquidity, if required, they will not be able to liquidate the underlying assets and it will be difficult to pay to customers if they have opted for redemption. Second is lack of availability of funds. If fund house do not have requisite cash in their vault, then it will be difficult to repay whenever redemptions come in, especially when there is surge in redemption, then it will be difficult for fund house to repay. It was the case with Franklin Templeton. There was surge of redemptions and AMC was not able to pay one thing. And second thing, these underlying assets of Vodafone, they defaulted on payment. So people come to know this liquidity risk. There is third thing, any mutual fund company, any AMC cannot borrow for investment purposes. Of course, they can borrow up to 20% of their assets for liquidity purposes, for repayment, for payment of redemptions, and that also for 6 months only. As per SEBI guidelines, mutual funds in India are not allowed to borrow for investment purposes. They can temporarily borrow to a limit extent, that is 20% of the net assets of the scheme for a maximum period of 6 months, and that also to meet only liquidity requirement. These borrowed money cannot be used for any investment. So these are the restrictions. Within that restrictions, AMC has to work. So now you would have understood the associated risk with all mutual funds, and accordingly, we should go for only those debt funds where there is less risk. You can see earlier you have seen almost same percentage of returns are possible from debt funds in same category, almost same. There is no so much of difference, but We have to take care of associated risk. Wherever there is associated risk more, we should avoid. Otherwise, chances of falling in any problem, any this liquidity trap. And one more thing, one should remember that in the case of debt funds, there is very hard chance, very less chance to recover if any company defaulted, as you have seen in the case of Vodafone and this Franklin case. If there is dent of 2% or 1% or whatever percentage in return, that will be permanent, almost permanent loss only. In the case of equity fund, we can see this. If one company defaults or if one company not able to perform, if others company performing, they can take over all NAV of that particular scheme, equity scheme at higher level. So there is chances of recovery more there. But in the case of debt fund, very less chances of recovery. So we should aware of all associated risk and avoid longer duration debt funds where risks are more. Of course, return may be more, but associated risks are more. So, in my personal view, retail investor like us should invest in low risk fund only, shorter duration debt funds only to get that benefit. And whatever balance fund, they should invest in equity fund to get maximum benefit for wealth maximization. In this backdrop, let us today discuss one more fund, banking and PSU fund. We will concentrate our discussion to associated risk only. As far as selection criteria and portfolio management is concerned, we will see in another videos when we will discuss about how to analyze debt funds and make a portfolio. So, as the name suggests, these schemes, these banking and PSU schemes, predominantly invest in those papers related to banking and public sector undertakings only up to 80%. Minimum requirement is 80%. If company wants, they can do. But those papers, commercial papers or bond, will be from either public sector undertaking or banking or financial institutions only. Here, another thing is balance 20%. There is no clear cut direction or guidelines where a scheme should invest. So this 20% is too much amount. If any risk is there, then investor may lose. So first red alarm is 20% without any guidelines. Second factor is there is no Macaulay duration defined for banking and public sector undertaking. So fund manager can have any duration fund, any duration debt papers, commercial papers, treasury bills, or bonds. And if fund manager chooses to have higher maturity period, then associated risk will increase. as modified duration will be higher. So one should aware of these facts. If you understand associated risk, then only you should go. Another one risk, in my view, is being a retail investor. We should avoid going to any sectoral funds. If banking and public sector undertakings doing good, then we can expect more return. If they are not doing good, then there will be associated risk more. So we should be little bit careful for that only. That also. Let us see some examples. This is IDFC, Banking and PSU Debt Fund Direct Plan. So here we can see this government-backed low risk. Okay. Once we'll deep dive, then we can see here bond REC. Okay, it may be this financial institutions, REC part, that part, triple A, this 9.43. But more important is HPCL, Hindustan Petrochemical, Petroleum Corporations, Refinery and Marketing. This is not related to financial institutions, NBFCs. Oh, so we should be aware of this. And same associated risk. So when we see all downside, okay, most of the are from financial institutions, triple A, but there are some companies which is not related to finance and totally another. See here we can see this power generation also NTPC. So like this we can see some deviations also and associated risk may be less, maybe more, depending. So we should avoid in my personal opinion. Again, we can see this ICICI Prudential Banking and Financial Services. Then here again, we can see a small industry development bank of India, and this is 8.36%. Okay, first one is Government of India fund. Okay, but this may be of higher duration. If higher duration, then interest rate risk is always there. So, in my view, we should concentrate to our investment for low duration or money market fund or ultra short term debt funds only. We should have had banking and PSU fund. Now you would have clearly understood associated risk with this. Another fund in debt categories is, let us see, this credit risk. Earlier it was named as Credit Opportunities Fund, and that was more misleading. People think that wherever there is opportunity related to credit, fund manager will go for that. But it is not that. Actually, credit risk fund are mandated to invest in AA plus, double A plus, or lower grade credit ratings fund only. So there is more associated risk here. Up to 65% they are supposed to invest there. Here we cannot see more because we feel this downside. Then you can see here all LAA minus LAA, AA, AA, AAA. So we can see all double A. There is no even AA plus So all are lower this. So this will definitely affect credit worthiness of this investment. Another thing here, this balance 35%, there is no clear-cut mandate. So that another risk is also associated. Third thing, there is no Macaulay duration defined. So that risk also involves there. So there are more and more risk we are seeing here. First risk is up to 65% they are mandated to invest in lower credit worthiness, AA plus or below rating only. So first associated risk is. Second, another 35% there is no clear-cut guideline. So that associated risk. Third is there is no defined Macaulay duration. And of course, this will be modified duration will also not defined here. So all this creating more and more risk. So we should avoid investing in such more risky products and go to our safer products as discussed in earlier phases of this one. Now, one another fund, popular fund is gilt fund or government securities fund. It is known as gilt fund from earlier days as in earlier days, there was electronically not available. So physical form, people are getting fund scheme, and that is left with gold. That is why it is known as gilt fund. But now nothing like that. Yes, of course, this is a government securities. Only invest in there. So there are two types of gilt fund. One is simple gilt fund, which predominantly invest in government securities up to 80%. They are mandated to invest there. Again, 20%, balance 20%, there is no clear-cut guideline. So associated risk is there. Another thing, again, there is no Macaulay duration guidelines. And of course, if Macaulay duration is not fixed, then modified duration is not fixed. And associated risk increases as fund managers get liberty to invest in longer duration funds. And there is, of course, associated credit risk, default risk, and more importantly, at least there is interest rate risk. As you know, RBI bi-monthly monetary policy keeps changing some interest rates, some rates here and there. And if it is for a longer period, there is definitely bound to change in interest rate and it will affect our bonds earnings. This from gilt fund. Another one, even more risky, is gilt fund with 10 years constant duration. And this makes it too much risky. If Macaulay duration is 10 years here, fixed this, and company or scheme is bound to invest in those long years fund. So more risky fund. So we must avoid such risky funds in my view. So associated risk we have defined. FR plan now balance this long duration. Of course, its mandate is for more than 5 years, so more risky, must avoid. Another is floating rate fund. That also is avoidable. It is beneficial only when if there is chances of increase in interest rate. So this will improve our return. If vice versa, then it will be definitely detrimental to retail investors' investment. So these are the all 16 type categorization, different types of funds we have seen. Let us see if any one left. All we have discussed money market, short duration, overnight liquid, long duration, medium duration, short, ultra short, medium to long, okay, risky. S1 is dynamic bond. Corporate risk, credit risk, all we have concept. This dynamic bond here again, too much liberty to fund manager. They invest in all sorts of bond from a smaller to higher as per market condition and they will chase for higher returns. So again, there is more associated risks. So all others are risky fund. In the end, in the summary, I would like to say that being a retail investor, we must go with only liquid fund. If our requirement for very short period, less than 3 months, then we should go for overnight. And another is short duration fund, ultra short duration fund. So these types of three, four types of money market fund, short duration, we should limit up to that much only. After that, we started our medium duration. All these are available. So our portfolio or investment horizon will be limited to liquid fund, overnight fund, ultra short term money market, and short term fund. Thank you. Bye bye.